All right, welcome in. Happy Wednesday. This is the Cow Guy Close, and I'm Scott Shellady, also known as the Cow Guy, and we're all lucky here that we're going to be the first financial show on today. You're going to hear about this all day and all night long, but we're going to be the first ones on air to get to talk to you about this big U-turn that we just heard from the Trump administration. So if your nerves aren't rattled yet, you must be made out of wood, right? We're witnessing some pretty historic stuff here. I would say that the crash of '87 and Black Wednesday in London in 1992 were the only other events that I've seen with greater, or at least witnessed with greater volatility in my career. Today's action in the bond market, I think, is what grabbed everyone's attention. That 10-year yield, which is a huge market, it's actually bigger than the stock market. That yield was spiked this morning almost up to 4.5%, right? It wasn't too long ago that we were trading at 3.85%. I mean, we're talking days ago. So that yield, I think, played a big role into what the decisions that the Trump administration made just about 20 minutes ago. Now, the streets rife with rumors, the most popular being that a large hedge fund was caught off guard or maybe had a bad trade on and had to liquidate a lot of bonds, driving yields higher. Who knows? But the reality is a spiking bond market with stocks as volatile as they are, that's not a pretty picture. Now, my next guest, he's been talking about this for a while now. Please welcome into the show, Mr. Eddie Ghabour. Eddie, I think you'd concur with what the bond market was doing, with the volatility that we've seen in the stock market. Something might have been broken there.
Absolutely. I don't think there's any doubt. I was looking at it early in the morning, looking at the Asia markets, watching this 10-year just rip. And when you see that, again, to use our terms, something broke, whether that was some type of hedge fund that blew up that needed liquidity, whether that was China selling treasuries, trying to come back at us for the trade war, something happened. And if that continues, that's a real problem. And so I think it would be nice to see that 10-year kind of calm down. And obviously this snapback here we've had in this market will hopefully cool things off. But coming into today, I would say we are in a pretty dangerous spot from a market perspective, where if that really persisted, that could cause other things to break in the system and some type of liquidity event. And that's the last thing we want to see. Yeah,
I mean, if you would have told me earlier today that we would see that 10-year yield shoot up to almost 4.5%, and that the equity market was hanging in there or maybe even trading, I would have thought that equity market would have really gotten tonked on the back of that. But maybe there's nobody left that wants to be short. I don't know. Maybe all the selling's been done. Who knows? But just to give everybody, an update is that just before I came out for this show, the Trump administration took back all the tariffs. They've just kept it at a 10% tariff and given everybody a 90-day reprieve while they kind of negotiate where they want to be. I think ultimately their line is going to be that there were so many countries, 75 of them, I think is what they said, in line to do a deal that they didn't want to punish them while they were in line. I get that. That's going to be how they spin it. But still, it's a pretty big sea change. And I think, I talked to you off air. I traded in London in '92 when George Soros tried to break the Bank of England, which he basically did. He had another gentleman that was partners with him at the Quantum Fund at the time by the name of Stanley Druckenmiller. I'm sure you know who he is. But there was a third person that also worked there. His name's Scott Bessent. And I think that he's intimately aware and has got great knowledge about these markets. And he had exactly your worries today, seeing what that 10-year yield was doing. And I think he's got the president's ear, because he's been put forward before Navarro and Lutnick now to be the trade rep, basically, even though he's the Secretary of the Treasury. And I think that ultimately there might have been some words there about this is what's going on out there. We got to be careful about breaking something. And maybe they came up with a decent plan to put China in the penalty box.
I think Bessent is the man for this job. He Absolutely. Is very macro aware, very smart. And when they put him in charge of starting negotiation with Japan a couple of days ago, we looked at that as a bullish thing for the market because, again, we think his knowledge of markets and how they work is extremely critical when you're going through tough negotiations like that. And so I feel comfortable having someone like him at the helm of this because I think he looks at it through the same lens that we do. And I think you have to be able to do that because you don't want any unintended consequences by trying to fix certain policies. We knew there's going to be a detox period. They warned us about all that. When you're trying to reduce spending and do some things and reverse things that have been going the wrong way for 30 years, you're going to have some disruptions. But there's a difference between disruptions and causing some type of major financial collapse due to not understanding how the system works. So I love the fact that he's at the helm.
Yeah, because I think he kept the overzealousness out of it, right? Because we've heard from other cabinet members about how we're going to continue on this path. We're going to hammer away at it. But sometimes, there needs to be a little bit of a, like you say, take a little bit of a macro look at things, and maybe some kid gloves are involved here rather than coming in like a blacksmith and bashing away at everything. And I think that's what happened. I really do. I mean, I have absolutely no knowledge about what happened, but your point and your note was fantastic this morning about how big of a deal. And you know what? And a lot of people don't know that bond market's bigger than the equity market. And when you see the bond market move like that, and the equity markets are as volatile as they were, that is very scary, right? That's a big pause for concern. And a guy like Scott Bessent would absolutely be onto that, right?
Without a doubt. And you know what my worry was? I didn't think we could go through the weekend and into Monday with that type of trend. That's how fast things can change, to your point, in the bond market. I mean, we could be looking at 4.75, 4.9 in quick order. And it's not just the level, it's how fast it got there. We were just under 4% 5 days ago. So to be at 4.5 in short order like that while the markets are crashing, that's a sign that, okay, you better proceed with caution or there's something big is going to happen. The bond market is smarter than the stock market, in my opinion.
I agree.
I've always lived by those words. And so I pay closer attention to the bond market than I actually do the equity market.
And I totally agree. And I'll end it on one real quick word, too. Another thing that you want to bring up, but you kind of alluded to, is we don't really pay much attention to it, but it doesn't happen that often. But the velocity is also something we really have to pay attention to, right?
It is. And this market has changed. And I think this is why a lot of investors now want more active strategies versus just passive, because the options market has caused volatility to move much faster, algorithmic trading.
Yeah.
I mean, we got the VIXs all over the place. So these types of gyrations, unfortunately, not to this extreme, but high volatility is going to be the norm moving forward. This construction of this market is much different than what it was years ago.
Absolutely. All right. Great to talk to you, Eddie. I love having you on. We'll see you again soon. Thank you very much, Eddie Ghabour.